I don't know if you guys are Spotify users for options, but there's this great podcast I listen to that, let me pull it up right now. I was going to screenshot it, but I actually found it last night. And, it gave a great breakdown on options. It's just called Stock Market Fundamentals. And similar to the Bloomberg ones, Spotify, the music channel, yes. I'm not sure if podcasts are available if you have the free version, but if you give your student ID, it's $5 a month to use. But it's a great podcast. It gives a lot of the history on it, of the stock market and just the basic fundamentals. And I like it compared to Bloomberg because this you can listen to while you're driving. You don't have to keep clicking the next after like the 30-second modules. So it's something you can do without having to be as engaged. So options, they're defined as a contractual agreement between two parties that gives the holder the right but not the obligation to buy or sell stock. So broken down into two kinds, there's calls and puts. A contract giving someone the right to buy a stock is a call, and a contract giving someone the right to sell a stock is considered a put. Bear with me here. Okay, so the terms of trade, these are agreed upon from both parties. There's 8 of them. They're defined as who buys and sells, how many listed contracts are traded. So they always come in a set of a minimum 100 shares that you're signing your contract on, and then how many listed contracts are being traded. So there's also what is the underlying asset that the listed option is based upon. It's the equity, ETF, whatever option that you're trading. What's the underlying asset? And then what type of listed option is being traded? The price of the listed option contract, the price of the underlying asset that the listed contract can be exercised at, the expiration date, and what style of option is traded. So there's American and European. I'll get to that in a second. So the history of the options, I thought this was pretty cool. I had no clue about this, but 350 BC, Greek philosopher Aristotle, he's credited with the first written record of an option in his work Politics, profiting from olive presses during olive harvesting season. So I thought that was pretty cool. It didn't actually tell me if it was him being credited for the creation of options or like the first him actually doing it, or if he wrote about it in his book. So either way, I found that very fascinating. So 3 types of participants. There's the hedgers. They trim risk on trading books to make sure positions don't become uncared for and overgrown. They use this example just as someone would be like hedging a lawn. There's speculators traders who wish to make a profit by capitalizing on a specific view they have on a future price movement of a stock. The definition was defined as they use capital they're prepared to lose in hope for a future profit. I think prepared to lose is a loose term when you're talking about someone trading stocks. Like I don't think anyone is truly prepared to lose their money. I think everyone goes in with some hope of like
99% that lose. Right?
Yeah. Don't be there. So arbitrageurs. I wrote down the pronunciation so I wouldn't mess it up. I probably did. Arbitrageurs. Yeah. Traders who try to earn a riskless profit. They take multiple positions to create a riskless scenario in order to earn a small profit. It's common for traders to mix these investing styles based on specific times. So right now, or maybe I wouldn't say right now, think of like right after COVID, after that crash, there's a lot of speculation going on. It's hard not to be a speculator in times of just booming stocks, everything going crazy. So a lot of people move their investing style based on kind of what's going on during certain economic times. Why trade options? There was 4 main listed ones. There's cost efficiency. Pretty much you have leveraging power, and you're not obligated to buy or sell. So once you sign that contract, you can just not buy or sell, and then you just lose the contract price. but you have the chance for increased profitability. So when successful, the magnitude of the trader's profit can seem to be disproportionately large when compared to their initial investment. During the modules, it walked you through different scenarios. I think it did use Apple as an example, but probably from like 2016 when they made these. It gave you a scenario where you bought Apple shares and then Apple options at the same price for the same amount of time, and it showed you how the stock will move the same, but you have a chance to have a disproportionately large profit from compared to buying individual shares. So you're also able to minimize your loss. You can use put options to be used as portfolio insurance. They can be used to protect traders against a downward movement in the stock. So I didn't cover this in my PowerPoint, but later on it gave you different strategies. The three listed were, bear with me for a second, straddle, strangle, and a collar. So it gave you two-leg strategies and walked you through pretty much all of them and showed you how to minimize loss or be able to strategically place calls and puts. Strategic flexibility. So also, yeah, you're pretty much just able to predict the market, hopefully, and you're able to make money regardless of kind of how the market's doing. Here were some of the terminal functions that were used during this one. Let me see. Perfect. This is all that I had. If you're not in the group meeting you'd like to join, you can go ahead. But so this will be the final meeting, just because the two modules I didn't cover, portfolio management, that kind of gave you like a personal strategy, and it would be hard for me to teach you because it walks you through some situations that kind of lets you dictate where the modules go. So a lot of scenarios. It'd be hard for me to teach something that I think you would learn a lot more from doing the modules by yourself. But I will send a copy of all the presentations in here in the group me afterwards. And then, are you signed up for the the actual modules? Oh, okay, perfect. Yeah, so I believe everyone here has. I thought I'd put this slide back in here, but you just go right here, use your UTSA email address to sign up for BMC. So you're able to do that if you're not already enrolled. But did anyone else, just a question for me to y'all, but there was an option to add it to your LinkedIn profile. When I was trying, I was able to put it in. Every time I would click save, nothing would happen. Like the screen would just freeze. So like, there's like a little thing that says, once you get your certificate, it says like copy to your LinkedIn profile. Just wouldn't work for me. Tried it on a different computer, tried everything. Okay. Yeah, I was just a little, all right, well, that's all I have. I'm gonna go ahead and stop the meeting. I appreciate y'all for coming to my classes throughout the semester. I had fun doing the modules, and I'll see y'all tonight at the investment study meeting, 7:45, I believe. So I'll see you guys there. Thank you, Camille.
All right, hello everyone. Hey Jay. So today I'll talk about the Excel model a little bit more, and I'll be talking to you guys about how you can be researching your firms more, Cameron too. So let me first go into the model. So you guys all have this model. Okay, so this is the model I've sent out to you all. So what I've gone ahead and done is, since nobody's taken the containers and packaging industry within our material sector, I went ahead and started taking notes on it and started looking at these firms so that I could talk to you guys about it. and then you guys can come up or understand how to look at your own industries. So let me just make sure everybody's in. I think Mel was trying to get in. Yeah.
International paper isn't containers packaging, so.
Yeah, I don't know why it was listed in there, but
It's not.
huh?
It's not.
It's in there. International paper is 67. Is it?
On my sheet, it's listed under containers packaging, so I thought I would be doing that one.
Yeah. Okay. Well, yeah, you can do that then. But I just started taking notes for this,
Okay.
so I'll just talk about this little industry for now. Okay, so the way I started looking at this is from our expensive and cheap filtering. I put that next to each of the firms, and so that way I can start to look at the firms more deeply. So I also look at their credit rating. So I drew all this information from Cap IQ, which you all have access to. I'll show you how to do that real quick. So when you come into Cap IQ, I don't know a quicker way at this moment, but I just look at the individual firm. So for instance, I'm looking at Berry right now. What you do is you go into their fixed income and you look at the credit ratings. And then you'll see here that their long-term credit rating is BB plus. So that means they're seen as they get a junk bond rating, right? So they're a little riskier. You'll get a higher return if you have their bonds, but we're going to look at them from the equity side, right? So the way that they're valued though is actually useful to us, because if you look at their credit ratings, that's the likelihood of them defaulting on their debt, right? But what they look at when they're coming up with the credit ratings is they look at their revenues, they look at their ability to bring in cash flows at the end of the day, their ability to repay their debt. Those are all things that are still helpful for us to know, right? So what I did was I drew each credit rating that was available. And what I did was I used our expensive and cheap filtering. And now you'll see highlighted that, for instance, Berry is rated as BB plus, so they're junk bond, and they're also considered cheap right now. So we can look at the actual numbers over here in this column, right? So we have Berry right here. So they are considered cheap. We projected a value of 11.17, and its value, or what it's trading for, is 8.25. So this is something that I'm interested in. I want to know more about Berry. I want to know if the market's already accounting for, this, for what we see here just on a basic analysis. So that's kind of how I put this together. And then, so what I look for personally, so you guys will know, is I like junk bonds that are almost investment grade. Now, again, the reason for that is because, or junk ratings that are almost investment grade. And the reason I like that is because that means their revenues are almost investment grade, that their financials, they're almost there. They could go either way, but if we can get them at a cheaper, at a discount, then, they're likely to perform, they're less likely to default, and we're more likely to get a better return since they're more risky, since they're seen as more risky. So that's what I looked for here. You'll see I highlighted these four. Xavier is doing international paper. Right now they're cheap and they're investment grade as well. More likely with the investment grade firms, the market's already going to be accounting for those discrepancies. So as you'll see here in international paper, they're cheap, but it's not by as big a difference, right? So it's like 1.6, and berry was about 3. So if you're looking at the difference between the two columns, so it just means that, you know, off of this basic model, we could earn more off of berry. Again, we have to explore that, dive into it more deeply, but this is just our filtering process to see, is this something I should look into more deeply? So again, you just go into Cap IQ for that. And then it would be the fixed income section and the credit ratings. That's how you find the credit rating. Also, in the Excel sheet that I've created, you'll see here this column. So what I have here is their products, and I look at their revenues, right? So I look at where their revenues are coming from. That's kind of important to know too, because when you're seeing news on these firms, where are they going to be most affected? You know, in materials like Vulcan, right? You've seen they've been doing pretty well. You know, are they likely to keep seeing sustained growth, or, you know, is something coming up ahead that the market's talking about that may impact your firm? Those are things you want to look at. So the way I come up with this information is, again, I go to Cap IQ, and this is just real simple. So again, we're going to look at berry. So in the financial section, you're going to see the segments. And then here, you'll just see their revenues are broken down into their highest down to their lowest. I mean, it's not in order all the time, but you'll see the international consumer packaging, that's their highest revenue. So if that's going to be impacted by some policy, you know, some international policy that's going on, then, you know, that's their largest revenue earner. And you can also see that it's almost 40%, 35% of their revenues. So that could have a huge impact. Also, I've looked into some of the news on berry, and they're trying to grow their North America base. So they've been doing that by having more sustainable packaging. And for that information, I normally go to Bloomberg, to the terminal, which you won't be able to do from home. But you can see news articles, you know, Yahoo Finance, just look in Google. But let me just show you what I'm referring to as far as berry. So right here, right? If I go into berry, if you have access to the terminal at school, you just type in the company ticker, then you can go to company news. So just go here, CN, it's number 5. And the article that I'm looking at is this one right here. So what you want to see is, you know, what's impacting them right now. So hold on. This is going to be all the news that's of pertinence to, you know, your firm, since it's specifically related to berry. Right now, it's a low filter. If you want it to be just things that are directly about berry, you can change the filter to higher. But I like to see what else is going on in the market itself. So this one looked interesting to me. And again, that's where I saw that they're growing, they're focused on the North American market. If we look back at Cap IQ, let's see. So the North American market, right now, they've had consistent numbers since 2015, but they did have a pretty sizable jump, about a 7, over the past 2 years, they've had about 200 million growth per year in their North American market, right? Now, if you see their biggest jump, right, that's going to be international. So while it's important to understand that they're growing the North American market, I'd be more interested in looking at what are they doing to keep this growth going on? Is that sustainable? So just more ways to keep looking at your firm. And Cam, do you have any questions so far?
No.
Xavier? No, okay. So if you want to keep looking at your firms, you want to dive in deeper, right? So another resource that most of you probably know about, so we're going to come over here. So if I want to look at the 10Q, you go to Edgar, SEC, right? So Edgar it's on the Security and Exchanges Commission site, and this is how you can look up the 10Ks and 10Qs for any publicly traded firm. Now, if they are private, they're not going to be on here because they're not mandated to report, right? So let's type in Barry. So look up Barry, and right now I'm just showing you guys how to get to these in case you don't know how to. So you can see here's the 10Ks and 10Qs. You can also filter. Let's see. So here's 8K stuff, which I don't know. Honestly, I don't really look at those, but they have earnings releases, all that. So what might be of most value is if you want to learn more about a firm is to actually look at their 10K, right? So start looking through their financials. You can do this again from CapIQ or Bloomberg. But start reading about them. What do they disclose as their risk? What do they think? If you look, just for example, so like right here, item 7. So this is the management's discussion. You want to see what they're saying, right? The executive summary. What are they talking about? Again, you can look at these things in the earnings reports. Which let me show you how to do that again, because I want you guys to get to know the firms a little better. So I'm trying to show you the resources to do so. So if I want to look at the transcripts, you go into Bloomberg, you type your firm, and then you go into the company events section. So that's EVT, number 22. And so again, you'll see here, I've done this before, but these are their earnings reports. They have the calls, and then these are going to be the resources that you want to look at. So this is the press release. This is the transcript. So anything that they said is available there. This is a presentation if they have one, so like an Excel slideshow. And then this is also the audio, so you can hear the CEO, you can hear the CFO, the press person actually talking. And what I like to do is I like to listen to them talk as I read through the report. And then I'll just pause and take notes as I go. So again, you just click on the document here. Here's the final transcript. Again, you get a lot of information from this. And again, my favorite thing to look at is the question and answers, which will be at the end of the transcript. So if you scroll down, pretty much everything before the question and answers is going to be available in the 10K or 10Q. But the question and answers are things that are probably not mentioned. The analysts are asking, what are you guys experiencing right now? So this is a very valuable resource to understand what they're going through. What does management see as potential problems going forward? Why did they experience some of the results? You can get to know your firm, and then if you look at their competition and what they're going through in this same light, then you can figure out kind of what's going on in your sector. So that's something I invite you guys to do, and I do that quite often. So,
No.
Xavier, any questions? No, you're good? Okay. Is it helpful in searching, or do you have any questions, like how to search for, or? Oh, okay. I'm just, since you guys are here, it's only check.
Yeah.
Let's go. Let's see, there's nobody else is coming in. All right, Jay, do you have any questions?
I'm good. Thank you.
Okay. Could you repeat, Jay? Sorry.
I'm good. Thank you.
Okay, no problem. All right, so that's kind of what we're going to talk about today. I'm going to go ahead and I guess I'll work with Cam here and then see what he's kind of got going on. Xavier, if you want to come over too, or it's your call. But I kind of want to see what you guys have seen so far. Cam, what have you seen with like Vulcan? Have you been using some of this stuff? Or FIQ, yeah. FIQ, and I've clicked on my phone. I Google, stuff. Yeah, where we get the scores. I don't really look at the, I mean, I know the credit rating and stuff, but I want to saw like one page on there. I really like, yeah, I mean, it was pretty important, obviously, for pictures, because really get the bond ratings. Because you don't respond, but even if we just use it as like a basis of like, where are they at? Yeah. What's it like really defaulting? That's pretty helpful. Do you understand how we like how we explain the filter a bit? And how I look at that? Yeah. I understand. Now, are you just looking at all of your packaging? Like you can look at all of them, or you should look at the ones that the ones you had? So yeah, those look more lucrative to me, right? So just there. So is that what you want to do with our token, yeah. Oh yeah, and so the thing is, since we're all doing the material sector, you can go further beyond your industry, but first I kind of want everybody to have a smaller section to look at, right? And then we can expand on that. So once you understand Vulcan, Martin Marietta, I want you to expand, and then probably when we do the presentation to the analysts, you'll probably just talk about that smaller section, or I'll give you some firms, but that way, it goes really well, right? So that's kind of where we're starting. Oh yeah, absolutely. You know that. Yeah. Yes, the Martin Marietta, which yeah, they're both triple B. Yeah, yeah, they're so Jay, since you're still on here, and Xavier, look at the mergers and acquisitions. Are they, what are they going out and buying? So that'll kind of show you if it's not exactly their traditional revenue source, if they're looking to go into something new. So let me explain that a little further. With Berry, for instance, it wasn't Berry. I don't think it was Berry. I think it was Sylvian Holdings. So I think their M&A. Let me just see if I can pull that up. Oh, well, okay. Let me just talk about Barry again real quick. So with the article that I was showing you guys, so what they just achieved was the ISCC Plus certification at their facilities in North America. So basically what that meant was they're just growing the company by providing more sustainable packaging, right? So that's kind of something that's important to, it's a hot topic right now, right? COP 26 going on. Sustainable packaging, they're making the right investments, right? That shows me that Barry is looking at what's important right now and what is important going forward. If they're going away from sustainable packaging, it's probably seen as more of a negative than going towards like being more eco-friendly. That's kind of where everybody's headed. But it is something, you know, good just to keep an eye on, that, you know, your firm is at least meeting the standards of the industry, or if they're going above and beyond, like that might be a reason to invest in them as well. So that's kind of why I like that article. What do you think? Okay. Okay, so you were looking at the segments, right? Segments, yeah. Okay. Okay.
Oh, it was 27 operations to take over for the 25 years.
Okay.
California, Texas.
So was okay. Logan is pretty expensive right now, right? According to the model. But
That's the reason.
it's something different, right? So you're really getting to know them. Have you, Martin Marietta? Now, again, guys, this model isn't the end all be all. You know, it's not perfect. Okay, so they're actually pretty much the same as far as expensive. They're about 7. This one's 6.33 difference. This one over here, not that far off. So I mean that is their closest competition, and they're trading about the same, right? Yeah, they're expensive, or relatively expensive. Have you checked out any of the smaller?
I don't think I've just done those two. Yeah,
Let's see. Yeah, let's look at it. Okay, well, let's see. So right now, guys, what I'm going to do is I'm looking at CapIQ again, right? I'm gonna look at Vulcan, and they have a lot of resources here to check out. So peer analysis is something really helpful. I'm gonna look at the quick comps, so see who they think is their closest competition. Clearly, Martin Marietta, you already yeah, you already know that those are close competition. Summit and Eagle, let's check out where they're at on our list. So, right, this is kind of how I look at things. So Summit is cheap, okay. And Eagle, let's see. Eagle is expensive right now, but let's see what their credit ratings are, right? So let's check this out. So we have Summit, and so this is kind of what I was doing as I was building the Excel model. So we're gonna look at the, so if the fixed income column isn't there and they don't have the credit rating for them, so that's not going to be as helpful, but let's look at Eagle. Yeah, Bloomberg might have it. From home, I was doing this stuff, so can check it out. So Eagle materials. And then, okay, so they have Eagle's credit rating, and they're triple B as well. So they're on par with Vulcan and Martin Marietta. So, and Eagle was expensive. But something I would look into is, right, since they're expensive and they're triple B, Martin Marietta and Vulcan were a lot more expensive, right? This is not as bad. So that might be something I look into. You know, are they making the same mergers? Are they showing the same strength in cash flow generation and revenues, and consistent revenue earnings. Well, why is it not as expensive? Yeah. That's kind of how I use this model to start looking into the firms more. Let's see. So we had Summit. Let's check out on Bloomberg. So we can look over here. Actually, let's see this. You saw the court? Yeah, I was looking for the court. Oh, but these aren't them. So it looks like Summit doesn't have any bonds out. So what we're looking for here is the equity is the stock, right? And then the corporate is going to be the bonds that a firm has. So I was going to look at what the bond was rated, but they don't have any. So let's see. Sometimes the credit ratings, the firms won't pay for the credit ratings. So that's something that you guys might encounter. Right here. Oh, my court. Okay. Okay, so they're rated lower. So they're rated lower, but that might be something I have to look into. What are they trending in the right direction? They're obviously not going to have the same revenues and cash flows, or they shouldn't have the same cash flows as both in Marty and Marietta. But do you think that the industry or that sector is growing? They're going to keep growing. Are they realizing the same growth that Marty and Marietta, or even higher growth? So let's look at that. So right now, let's see, so let's check that out. Financials. And then, so what I'm going to do here is, there's other ways to compare, but for me, this is a quick way. So I'm going to pull up Summit, pull up Martin Marietta.
All right. I appreciate it very much. Thank you. You too.
Okay. So I'll pull this up here. So use half the screen for one and half the screen for the other. And then this is just going to be an easy way. So on the left here, we have Summit. On the right, we have Martin Marietta. So you'll see. So over here, Summit had high revenue growth in 2017. And then they've been pretty consistent, about 6% revenue growth year over year. And last year, Martin Marietta captured a lot of that growth, but look at the year before, they had negative revenue rate growth. So that's just where they're trending. So the gross profit, their margin's about the same. Summit's had actually stronger gross profit margins. All right, see exhibit. You see, start looking at it. What do you see? I see. Yeah,
That's kind of weird how they went from 11.7 to maybe, I don't know, I think COVID affected it because it didn't affect the end.
well, yeah, I mean, they have consistent revenues for the most part, but their growth, I mean, that's just one way to look at it, is the growth.
Yeah.
If you have more consistent growth, I like that versus here it fluctuates more. So me personally, I like Summit and the revenue growth. Also their margins, they're smaller, so their gross profit, they got higher gross profit margins. It's harder to do for my opinion. So this is one thing, we'll look at what is the cash flow. So free cash flows. Okay, that's really it. Cash flows, okay, so negative, but the past few years, it's pretty strong for their size, right? Yeah. So on the revenues, right, so we have, so past 3 years have been about 200 average. Before that, 50. So relative to the revenues, not even 20%. Okay, so about the same. It's not much better. Yeah, that's one way I'll start looking at it. So there's segments. So another important thing to look at is their segments, right? So where are they operating? It's kind of, where is the need in the country, right? Or wherever they're operating. So for instance, I'll just use real estate because it's easy to think about. In the real estate markets, right? You want your home builders to be in places where there's high growth, right? You want that need. You want there to be a need there, and your home builder will meet that need. So it's the same thing if you think about with materials. Where is there high construction? Where is there a need for these materials? If we're in packaging, are they working with? Are they working international? Are they working just North America? What is their target market? And where, if you're looking at the news, are they going to be impacted? So, makes sense, right? Okay. I think everybody kind of thinks about that, but just when you're looking at the numbers too, just think about that. Think about their segments. Right here, you can see. So what are they focused more heavily in, right? So ready-mix concrete, right? So again, they're probably going to have higher home builders. They're going to have, projects related to that. Yeah, just try to understand where the revenues come from. Also their costs, the cost of the revenues are those things that can suffer. Are those things that are currently suffering, as we talked about last time with like lumber, when they experienced, that peak and now they're back down to more normal prices, how does that affect our sectors? Is something like that probable to happen again? So just as you're reading news articles, keep an eye out for that. If you note something, write it down, kind of like Cam's doing. Write it down, let's talk about it and let's try to understand the industry better. So I appreciate you guys' time. We're almost out of time. So reach out to me if you have any questions. We also have a group meet, which I set up. So everybody join that. We can shoot out some articles through there. I'll do the same today. So thank you guys and look forward to seeing you next week.
I can't remember what my color means, but I think we got all the assets forecast we're down.
Liabilities, we almost finished liability.
So we had, I don't remember why I highlighted these two. We need these separates. So
Yeah, that was,
let's insert some rows. And what we said we're going to do is try to figure out what they're most highly correlated to. So if we do the change in the liability, and I forget what choices we have, but let's go up there and look. Let's see. Our choices are change in accounts. And I don't know what change in AP means. But anyway, so we'll just do a correlation between each one of them. So equal coral,
I don't think you're sharing your screen, Professor.
it should be.
Or maybe the wrong one. All I can see is the desktop.
Here, let me try again. Oh, this is the one where, yeah, I'm sorry. The two screens is so, okay, sorry.
It's okay.
All right, so we're going to look at the change in this account. I'm going to lock that in, comma, change in whatever AP is. We can copy that down. Whoa, that's unusual. Right, it's not really highly correlated to anything other than SG&A, but I'll go with that. I don't know what else we're talking. Other current liabilities. So we separated out unknown revenues, and that one worked out pretty well. Other current liabilities is, well, who knows what that might be. It's not a small number. It's not a massive number, but it's not a small number. I'm going to go percentage of SG&A just because my SGN, what is SGNN? It's just be SG&A. I typed that wrong, but all right. So it's got the highest correlation, so we'll go with that. So we just got to take the 125 and divide it by SG&A, 6%. I'll copy that across. Boy, it took a huge jump in 1 year, didn't it? Boy, just not very stable. So they're doing something. This is where the accountants are messing things up for us. Something wild is going on. The last few years, it's been more like 20%. That's something, you know, we would research. What changed in this year to make what's in other current liability? And we can always look, right? Let me get into Bloomberg. You can always look and see if we can find something fast. If it's one particular line, we can see maybe that's a line we need to separate out and do it on its own. A lot of times, you know, coming from Kappa IQ, it's going to be the same level of detail that they have in Bloomberg. So I can't remember if we combined lines on that one or not. I don't think we did we?
for other current liabilities.
Isn't that just all one thing? Just
Yeah, everything but debt is a liability. So
no, we're only adding one line. It's line L52. We didn't want to combine other current with other because we want to keep that as a net working capital. But let's look and see what Bloomberg gives us here. So let's see if we can even match the numbers. So I'm going to go to the balance sheet. Other short-term liabilities, deferred revenues that we're separating out, right? Miscellaneous, is it the 4.265 or 3.44? Is it this number here? That's probably it, isn't it? Because we took the deferred revenues out as a separate line, 2 billion. Yeah, it's that number because there's our deferred. So 4,561 is going to be, there's something else in ours. Who knows what it is, but yeah, that's all we got. Miscellaneous short-term liabilities. We don't know what it is. it certainly jumped dramatically all of a sudden. All right, so all we can do is just on this one, we'll just have to, go to the annual report and try to figure it out. But for right now, we're just gonna put an assumption in there. Now, let's see, it's been stable at least the last few years, and it has been fairly stable the last few years. So I'm gonna go with 21%, and we'll just see what that makes our balance sheet look like. So now we just take SG&A times our percent. We can look at the forecast and see how reasonable it looks. Obviously, it's going to be bouncing around because of the last few years. All right, and then my new normal approach. Let's graph it real quick. It's kind of hard to graph stuff when you have the freeze frames in it. That looks reasonable to me. It's rising with your expenses. So yeah, I'm not real confident in that, but since I don't know what it is, I've talked about this in class, how much I hate other, and that's one of those other that's several $1 billion. All right, so that takes care of that one. I'm not sure why I'm highlighting them. I think, yeah, I'm not sure why I have these highlighted. I'm not sure what my thought process was there, but I think we've done everything. All right, so tax, debt, total debt and taxes, we're gonna add a couple of rows there. We can get rid of the row up here under SG&A. So taxes and leases. This one we're gonna do percentage of net worth. Obviously, that's gonna create a huge circular formula. We'll talk about how we'll get around that. So we'll just take this divided by net worth. Oh, we got to bring net worth in here. So total common equity, that's an easy one. See, we're in column J. So just go get our total net worth, column J, total equity. We can just bring that over. We don't need all those detail lines on equity. I don't know if you remember your accounting classes, but finance doesn't care about paid-in capital and those type of things. It just doesn't mean anything. All right, so debt. I know leases are in there, so we may get a little bit of noise, but we'll just do it as percentage. Let's see how stable this is. It's probably going to jump around a little bit. Yeah, that one's pretty volatile, but it kind of makes sense, right? Firms pay off debt, issue new debt all over the place. So I think I'm gonna go with a 50%. Something changed here. I don't want to use the average for the whole period, but they're kind of around the 50%. So now the problem is we can't actually put that one down, because if we do, we're going to get a circular formula. So we're just going to leave that there for now, and I'll show you how we'll get back to that a little bit later. The tax liabilities, had a couple of rows there. We're going to try that as a percentage of income taxes. Hopefully that gives us something decent. The accountants are so weird on this one that I'm worried we may not be, but it's essentially the only logical thing to do. If we don't do that, what else is there? So let's see if we get anything reasonable here. I personally don't actually care for the deferred tax as an accounting thing. I don't think it really helps us in analyzing companies. So the last year, something strange happened, probably related to COVID, and probably related to that big write-off they had. But I'm going to go with 30%. It's a small number, so that's the other thing. If it's a small number, it's really not that big of a deal, right? So 30% is a reasonable number, and it's not going to affect our forecast all that much. So go get net income times 30%. I mean, income taxes times 30%. that one taken care of. And I think this one's actually gonna look like a fairly decent. It's gonna be really lumpy, but I think it's gonna actually look fairly decent. That looks reasonable to me. It almost looks like it does that every few years. All right. Got one more line to go. We're almost finished with the balance sheet here. So other current liabilities, we're going to do the same thing here. See if we can find some relationship. So we can't do that until here. So we have to go over to row J and take the difference. Let's do our same culprits before. So equal coral. Well, I wish I knew what that accounts payable is. I need to go look and see what that is because I don't really understand that. Where is it? Change in AP. Forgot to lock it in. Sorry. So no correlation. Well, at least we're over 50% somewhere. Wow, very strong correlation to what? SG&A? Which one was it? That would make sense, SG&A. I kind of was wishing current liabilities would have had that relationship. That makes a lot of sense. What is AP? I-48. Oh, this is the actual change. So I don't even need that one. All right. That was for us to figure out the correlation for AP. So yeah, it makes sense that liabilities are not related to that. All right, so we're going to use SG&A, and we've got it. Percentage of SG&A. So plus that divided by SG&A. Obviously, it can be 0% for a while, but then it had that huge jump at the end. So, you know, that's the one where like we're not really sure what's going on here. What was the other one that did that? And Bond, I don't know on your paper 4 what you did to address that. It's been an account that's been really immaterial, but I thought we had one other account that had a huge jump. Maybe this was the one. We can get rid of this now. Need that anymore. Maybe not. I don't see it now. All right, so we get this one account. So the question is, did it jump up and come back down? So one thing we can definitely do, and I really encourage this, so let's find it. Here's here it is right here. You can see it jumping up to 2.4. Is that the same one though? Boy, it seemed like it jumped more than that. So it went from 6 to 2.4. Here it is right here. I don't see the 6.
They have it as 1.9, right?
Yeah, 1.9 and 2.4. I don't see the 600 that we're looking at. Total liabilities. That's about the only one it could be. So what I'm going to do, well, I just don't see the huge jump that we're seeing. Did liabilities jump on ours in total? Total liabilities went from 30s. Well, they've been jumping pretty dramatically. I think part of it is that tax liability. I think the tax liability is actually wrong. I think this tax liability is actually theirs. So I'm gonna cheat, and I'm going to make this the circular formula. I'm gonna make this 814. Y'all see what I'm doing? I'm cheating. I'm gonna make that 814, and then I'm gonna subtract. I'm gonna do it in here so I know I did it. All right, that makes it a little more reasonable. So I'm cheating a little bit because I really think they did something strange there. That gives me 1.6. Does that give me more in the ballpark of the numbers? It jumped up. So the other thing we can do is we can look at the quarterly and see if maybe it jumped back down after that. That would give us some confidence. Miscellaneous. No, it's staying up there. So whatever that jump was, it's when did the year end? Maybe that is their year end. Maybe we don't have more current data. Is that the last quarter they just report? So, all right. So we got a question there. We do more research on that. We don't really have time to do more research on that, but we would do more research on that. All right. So the question is, what do we use? It has bumped around between 7 and 8. So I'm gonna go with 8. At least it's not, you know, the 2.4 billion. So that I think part of this is they're reclassifying. We'll see. I may have made a mistake doing that, but right. So we'll just take SG&A. The ultimate is, do the numbers look reasonable? It's some of the stuff's not that important to the value of the firm. So we just got to make sure we got a reasonable balance sheet. Let's do our total liabilities and let's just see if that works. See if they're at least going up. No. So what are we missing? We haven't done debt yet. Okay, so we got to do that. All right. Okay, so we're getting close here. So common equity, this is going to be the tough thing. So we're going to have a little bit more lines here to get this figured out. So what common equity is going to be is prior plus net income minus dividends minus stock repurchase. All right, so we're going to have to figure that part out. So let's handle minority interest first, and we'll come back to that. Why do I have a reference there? Oh, because I deleted those. All right, so we finished everything but debt to equity. Let me get debt to equity in there. So, all right, so the way I handle debt to equity is we're actually yeah, boy, how did I do this in the past? I have to go look at my my Walmart example. Let me pull up my Walmart example. I can't remember how I did it. Where's my Walmart? Let me search on Walmart here. Bloomberg, boy, it's just too old. All right, let me try it again. I thought I used Walmart, just, there it is, okay. All right, let me look and see what I did in the Walmart and see if we can copy that approach. So our goal is to avoid the circular forecast, the circular reference.
Equity, right? Everyone.
Yeah, so.
Debt divided by net worth. Line.
But how did I get it so we don't have a circular format? Right, so my debt to equity, I got the history there. I'm assuming that. So 82 times 87, right? So the net worth is there. How did I get the net worth? All right, so we're gonna have to build all of this down here. So I'm getting my previous years plus net income minus dividends and stock repurchases. Okay, so we need to build in dividends and stock repurchases into this spreadsheet. That's the only way to do it. So I had it right. I just didn't finish it. So I don't know. Let's do it down here because we're gonna have to do something with that more minority interest. So let's do I tell you what, let's just put them all under net income, dividends, stock repurchases. So net income we have up above, right? We can just go reference that, wherever that was. Right, dividends are on the cash flow statement. I forget what year we're starting with. So we're starting in 98. Cash flow statement. 1998 is again column I, because we added that column on the other one. All right, so let's find a cash for cash for financing, special dividends, other common dividends paid. Column I. Why is that 0? Common dividends, okay. Special dividends, I don't know why they have that. Other financing activities, no telling what that is. I'll ignore it for right now. Well, why did I get? Oh, because sorry guys, we're going to take those dashes out again. What did you say to do?
I do the
Find that and replace it with 0. Place all. That's a smart way to do it. Why is it? There's something that it's telling me.
You might have to control A, like select all maybe.
Well, it's like there's a button that it's supposed to tell me,
Yeah, it's not.
yes, you did this.
Huh. Did it work?
Oh, there it is.
It works.
There's that. I wasn't finding that little pop-up box. Okay.
So just those two specials.
Well, let's look at them here. Let's see. We've got at a debt issue. We don't really need that. We're going to handle that with the balance sheet. So we do need issuance of. So we're going to take issuance of common stock minus repurchases, because issuance is going to increase our net worth. So we'll take those two lines. So that's lines 55, 56. And then I don't know why they have so many extra lines. I'm going to take line 59 and 63 for dividends. 59 and 63. They keyed them as positive numbers, which is kind of interesting. Usually on the cash flow statement, if it's a cash outlay, they show it as a negative, but they're showing it as a positive. So, okay, so equal.
You should think, oh, and 63, not 61.
Yeah, I want to do 63 just because it's not a big number and I want to just get rid of it, actually. Sometimes it's easier just to pretend it's not there. Let me just kind of bring it in. So column I got 67.
Yeah, I got that same number.
Okay, and the last one's the stock repurchase. I forget what I said, which line that is, but
Fine, just say something else.
it's the net of those. But are they showing? The strange thing is the issuance repurchase, they're showing both as positive numbers. That's really strange. So we want to do minus the issuance plus the repurchase so that it's a net. So minus the issue.
6 minus 55.
Yeah, so I get negative 74, which means they issued stock that year, right? So then we'll have to do other changes. Then we get change in net worth. All right, so their change in net worth, we're going to have to go. I tell you what, I want to add one more thing on here. Is beginning. Let's set it all up just so we know what we're working with. Beginning net worth and ending net worth. I want to see the whole thing. So beginning net worth, we have to go get that from the balance sheet because we don't have that one. So beginning net worth, total equity. Here we want to go to column I instead of J, right? Our starting is 3071. And so our beginning is 2655. Our change in net worth should be net income minus dividends minus stock repurchases, and then plus whatever the other changes are. We take that plus that. We have our actual change in net worth. Our actual net worth. Actual ending net worth is 3071. Let's see how big these numbers are. So we're missing what, 51 or something? So here, let's see if I can get this to work. So we want plus beginning minus, I'm going to go opposite direction, minus that, plus that, plus that, minus ending. Nope, I must have been the wrong way. Let's try it the other way. It's not that big of a number, so I get some. All right, so y'all see what I'm trying to do? I'm trying to get that plug number differences. Maybe I can just do, I thought if I do minus that, plus that, plus that, so that's 467, but we actually need that minus that. Am I getting closer? No, why am I getting that 982? All right, my brain's not working here. So how much are we missing? So it's pretty obvious. So we need 3071 minus 2556. So we're missing, I need 48 to show up right here. So I got to figure out the math, and William's probably already got it figured out, but I got to figure out the math. Or Bon, you probably got to figure out. Bon, you see what I'm trying to do here? We know net worth has some other things in there, 48. We're hoping that 48 is going to be really small across. I just got to figure out how I get that number. So,
Yeah, no, I'm pretty confused.
all right, so net worth actually changed 3071 minus 255, right? That's how much we changed. But we need to subtract out that. I think it should be like that, right? Ah, I got it. Okay, there it goes. So my change in net worth is 515. So it's I took beginning net worth, it's 2556. I added 460, subtracted 67, essentially added 74 because I issued stock, and then needed a plug of 48. So Bond, that 48 is my plug, so that I get the right change in net worth. All right. Now will this copy over? Here, my beginning net worth is my previous ending net worth. So does that look good? That worked. Now let's see how huge of a number we're getting. This one worries me. Boy, the accountants sure know how to mess stuff up. Let's see how huge that number is. I went too far. It doesn't look all that bad. Until the very end, it does get kind of large there at the end. All right, does Bloomberg provide a statement of owner's equity? I don't think they do they? Do they reconcile at the end? Yeah, they don't. It'd be nice if they had a statement of owner's equity. Does any firm even report that? And I always say we don't need a statement of owner's equity. Here's a time where it would have been nice because we want to know what that other thing is. Let's see if we can find anything anywhere that is going to help us. Retained earnings should just be changing by net income minus dividends. That shouldn't be a big deal. Other equity, it could be that minority interest. Let's try that. I'm going to add one more line in here. So let's try this. change in minority interest. So my minority interest, I think it's 0 to start out, isn't it? So minority interest. All right, well, let's bring that minority interest in. It's on the balance sheet. There it is, minority interest. So it was 0 to start out, and then it gets rather large over time. So if minority interest increases, then that should reduce. Right, so the first year I'm just going to type 0. So minority interest. We want to subtract that. So subtract the change minority interest. I go wild on the in here we're going to minus that. Let's see if that worked. Get rid of this. Well, that made the chart look a lot better, didn't it? That certainly helped. Let's see. The question is, am I matching? No, I'm off. So did I go the wrong direction?
Yeah, I'm getting, what was the first number you had for the change, right?
First one was 35. Does that sound right? Yeah, because it went from 0. Did I? Oh, you know what I did? I should have started in J, right? All right, so there we go. All right, that'll make a difference.
Yeah, that looks more like mine.
All right, yeah, sorry, I just picked the wrong one. All right, does that help with the balancing? Okay, minority interest. I got to take this 105 minus minority interest minus I, right? 105 minus 82. All right, there we go. Okay, maybe I went the wrong direction here. Let's try doing plus. You know, I'm all for no. Why am I off by now? I'm off by 17. Off by the change. Oh, you know why? Because I didn't put it in here. Okay, sorry. There we go. All right, I got it to work. All right, y'all see what I did here? So you bring the change in minority interest in, and you got to change the change in net worth to subtract out the change in minority interest. And then my other changes, you know, I'm doing the opposite. So I added back there. I don't know, Colin, you kept up with that, but that looks like it works. Let's see if that helps our number much. Everything balances. That's kind of nice. So other changes, it's not quite as huge of a number, but it's still a pretty good sized number. I wish I knew what that was. That's what bugs me, and they're not telling us what it is. Let's look on Bloomberg and see if maybe on the income statement they give us a reconciliation. So let's just look and see. No, they don't. The balance sheet, what else could it be? So we said minority interest, that makes sense, that would have an impact. What else is in the yeah, that other equity, I have no idea what that is. Here's the minority interest. So we took that out. Why are they adding minority interest then? So this is equity before minority interest. Adding minority interest. All right. I'm going to have to think about that. I'm not a minority interest person. I never had to deal with that. So why are they adding minority interest here? So this belongs to the stockholders, this belongs to somebody else, so that's their true net worth. So some of their net worth belongs to others. So maybe I went the wrong direction. I'm gonna have to think about that. We're gonna leave it like it is right now. We've already got the treasury stock. The paid in we're gonna have because we've got the stock issuance. And what other things the firms have? So financials, any unrealized gain you have on investments goes through that line. And that can be a sizable number. I wouldn't imagine Costco has a huge investment portfolio, but that can be part of it. But boy, I wish they had a statement of owner's equity. Does Costco have a statement of owner's equity in their?
I am not sure.
I can't remember ever looked.
No, they don't.
They don't?
No, I put it up.
They don't. All right. So is that just a statement no one does anymore? What about a statement of comprehensive income? All right. So let me research that some. We're just going to leave it like it is for right now. We'll just plug some numbers for now just to have something in there. But I have to research that more. I'm just not sure. It's a big number, especially, $2 billion, $3 billion, $2 billion when your net worth is 18 billion. It's not a inconsequential number. But so we'll just have to. All right, so let's bring this over. We're not finished with net income yet because we don't have interest expense in there yet. And dividends, we're gonna have to build dividends. We'll have to put that in. We'll do dividends as a percent of net income. And bond, you already know that's gonna be an issue, right? Because they're so volatile there.
Oh,
Well, we'll probably, it's at least looks predictable to me. It's not like they're 12%, 80%, 5%. It's like it's a pretty normal number for a few years, and then a really big number that's pretty constant every other year or so. So let's just look and see. What is that? Every 1, 2, 3, 4, 5, 6. 1, 2, 3, 4. No, it's kind of all over the place, isn't it? Did you find any rhyme or reason for why Costco does that, Bond?
not specifically. That money builds up, and once they feel comfortable that they can redistribute it, they give it back.
All right, so I'm going to assume. Oh, we got one more year to go here. Sorry. I do have another year, so why is. They just not pay dividends last year? We have okay, I don't know what happened there. That's 2021. We should have numbers there. I don't know why. So I have to figure out. But anyway, I'm gonna just assume I might this next week finish this so we can get to the cash flow statement because I really want to get to that. So I'm just gonna assume 60%. Boy, when they go up though, man, they go up a bunch. Boy, that is just let's see what the average is. Average is 70%. What if we get the more current years? Let's go with 70. We'll see. So I got to figure out what's wrong here. Do we have a problem with the I and I, right? I and I. That goes over to, oh, they are zeros. Why are these zeros? That's press release. That's 2020. Okay, I'll have to plug those numbers in. Don't we have 2021 everywhere else?
Yes.
So why didn't they give us numbers there? So I'll just have to plug those in. I'll have to go find it. All right, so that's definitely something to fix. So we got a few things I'm gonna have to fix before next class so we can get there. So, but anyway, we have dividends. It's gonna be 70% of net income. That looks reasonable, right? Given what they've been doing in the past. I mean, it gives us dividends of 4 billion on average. They've averaged 2.6 billion. Sounds a little bit high. So let me come down to 60 and just see. That gives us 3.4 billion average. That makes some sense to me. Stock repurchases. I'm just gonna go with 500 there. They look fairly consistent. Did you hear anything on their stock repurchases, Bond? It looks like they just do a few hundred million every year.
Yeah, they're just slow and steady with it.
So any number there makes sense. Change the minority interest, you have to figure that out later. These are the next ones you have to figure out. Okay, we can't do anything until I get these numbers in there. So I got some. All right, so what are we left with? So let me highlight in yellow what we're left with and remember that next time. So we got to do minority interest. Oops. That we're going to probably just plug in numbers. It might be a percentage. The change might be a percentage of net income. So I don't know, Bond, you know anything on the minority interest? I really don't know what that means. So we're gonna have to figure that out, but it's not huge. We got to do debt. We got to do debt, total debt. We still have to do interest expense, right? Interest expense is going to be actually pretty easy. We're just going to take prior year's debt and multiply it by this year's interest ratio. I think that's all we have left. Right? Are we missing anything else? I need to check this line. Figure that out some, because maybe I should be subtracting it when I'm adding it, but we'll have to figure that out.
With those net worth formulas, are those plugged in from total common equity?
Yeah, just total common equity. Bottom line, the second to bottom line on the balance sheet, total equity. Yeah. Once we do that, then we get the fun part, which is my favorite, is building the cash flow statement. So once we get that, the cash flow statement will simply be making sure we have the change in cash. So as long as we take the change in everything else on the balance sheet and account part, that will equal the change in cash. So we'll just go meticulously through to do that. That's something that I'm sure we won't get to work in the class, and I'll give up and then I'll do it myself outside and I'll tell y'all what I fixed. That's what we had to do last year with Facebook. But I finally got it to balance. And that's the where you add when you should be subtracting kind of thing, you know, just all over the place. So, all right, we're making progress. The worst part to me on forecasting are these small items like the minority interest, the dividends, the repurchase of stock. Those are things where sometimes you just have to plug a number in. For Walmart, like with Goodwill, I just plug the number in. Miscellaneous other things, you know, sometimes you just plug numbers in. So, all right, let's save this. I think we can be done by the end of the semester. We'll see. We may have a little bit much. There may be some things, you know, I'm going to just say, you know what, we're just going to plug something in and go with it because I don't want to research it anymore, even though it is material, which means in real life, you're going to have to do a little bit more work on your own to figure these stuff out. Actually, Bond, I'm actually pretty interested in that. If you pulled up the annual report and searched on minority interest, Costco also made 2 important investments this year, the acquisition of this and a minority interest, and that's their minority interest in somebody else. Who has a minority interest in Costco?
That's all it says.
All the way throughout? Oh, that's the only 2 we have. Yeah, so yeah, they have a minority interest in somebody else. Maybe that is what it is, but that all happened in 2020, and this minority interest goes much further back than that. So, hey, this is your company, Bond. You got to know that all the way down to $1,000. You know, anything they spend money on. in real life, that's what you do, right? And for this class, that would be a little much. But yeah, I don't know why they have a minority interest. It doesn't make sense to me.
Where's the next place you would go to look?
Well, it's the annual report. It should be in there somewhere. Maybe the most logical thing is to look at the first year it showed up and then go look in that annual report. So minority interest showed up in 1994. That was the first year it showed up.
Hmm.
If it didn't really jump, it's just been kind of continuously bouncing around. I think there's one year it really jumped a bunch. So like this year, the 571, that might be a year to go look it up. That's 2011. Why did minority interest suddenly jump in that year? These are balance sheet items. This is not an income. It's not like the minority interest made 571. The minority interest, their share went from 101 to 571, and then it dropped back to 157. Maybe it jumped up because they had a really great year of earnings, and then they paid out a distribution the next year to the minority interest. I don't know, but I don't understand that. This is probably one on the balance sheet we're just going to forecast, but I want to see if it's any way related, if the change in minority interest is any way related to the net income. If like the minority interest is getting 5% of net income or something like that. But if they're making distributions to minority interests and we don't know what that is, I don't know how we're going to reconcile that. But I really don't know off the top of my head if we're doing the right thing by adding or subtracting that. I think I subtracted it.
I mean, they do have a line called non-controlling interest on the balance sheet.
Is that the same numbers as our minority interest?
514?
Yeah.
Yeah.
So we need to look that word up in the annual report, non-controlling interest.
So yeah, so I looked it up and Google says that they could either call it minority interest or non-controlling.
Yeah, but I mean in their annual report, but I mean in the footnotes, something that tells, oh, wait, look at this. Non-controlling interest. They got 45. So doing it as a percentage of net worth would make sense. We need this statement right here, Bon. Here's your answer. This is going to be real helpful for us. Statement of equity. There it is. There's the statement. There's the statement we're looking for. All right. Hey, good job. All right. So that's the word. So that answers your question. There it is. Company reports non-controlling interest and consolidated interest at a component of equity separate from the company's equity. That is a sentence that means nothing to anybody but Walmart employees. All right, so that's what we got to do. Bon, let's figure out that is. I'll do a little bit of reading on that. So, all right, good. It's forensic accounting.
And one last thing, Professor, what was that formula finally for the other changes that we could have?
It was just whatever got us to get the balance, but
So I'm just trying to plug in.
I did plus ending net worth minus beginning net worth minus net income plus dividends plus stock repurchases, and then I did plus the change in minority interest. You essentially want to go the exact opposite to what the bottom line is doing. All right, we're getting closer. Yeah, it's part of this exercise is to see the tediousness of this. I've done this quite a bit where, you know, I'm sitting there all day, 10 hours, just working on a company, and sometimes you give up and do something that looks reasonable and don't tell your boss that you just plug some numbers in. I doubt minority interest is going to be a major part of our evaluation of Costco's. All right, that's it. Thanks, Bon. Glad I got you in this.
Professor, do we have an alumni speaker for tonight's meeting?
Yeah, Tibby, elderly. I can't say his last name. And then Tibby.
And then I think we decided Bennett was feeling a little bit under the weather, so we decided to do an all online meeting tonight.
Oh, no one's going to be in the room?
Yeah, I don't believe anybody's going to be in the room tonight, but we'll be back in there next week.
Well, what about people that show up that don't know that? Y'all announcing that, or?
Yeah, we already made the announcement to the big group.
Okay. Well, I'll stay around and go up there just in case people show up, and then maybe we can do it in here by Zoom. So.
Gotcha. So yeah, I just wanted to let you know that, and will you send me this updated spreadsheet when you get a chance?
Yeah.
And then the last thing, my sector spreadsheet from last Thursday, I saved it to your desktop on the computer.
Yeah, I think I saw it, so, okay,
Okay, as long as you still have that, that should be fine.
okay.
Alrighty, thank you so much.
Email it to you, or you just want to leave it on the machine?
Either way, you can send it to me if you have time to do that.
All right, I'm gonna go eat real fast, but I'll do it after that.
Sounds good. Appreciate it.
All right, thanks, guys.
Hello everyone. Hello everyone. Welcome to my class, Resisting Censorship with Blockchain Tech, Class 5. And I know I sent out an email with my PowerPoint, and it says Class 2, even though it's supposed to be Class 4. Sorry for that kind of mistake. I gotta check my PowerPoint and see if I'm sending the right version. Anyways, I do want to give a disclaimer like I usually do with my class. Okay, disclaimer. All information shown in this class is intended to provide is not intended to provide personal attack nor financial advice. This information presented is intended to be consumed and used only for educational purposes only. I'm not an investment, nor am I a tax advisor. I'm not an investment advisor. It makes it seem like I'm an investment. I'm not. I'm still a college student. I have to fix that typo. Please consider your own personal circumstances and speak with professional advisors. Independently research any data and information you may rely on, whether for making an investment decision or a tax decision or otherwise. Anyways, disclaimers over, and I'll post the class attendance at the end of the class. For now, I just want to jump into the PowerPoint. And by now, you guys should know what blockchain is. I kind of explained it over a couple of classes. If you guys really don't know what it is, feel free to ask me. And the NFT question, yeah, I kind of explained it too. Now, let's get straight to the class. I do first want to kind of explain how apps exactly work. I was planning on upload a video to the PowerPoint. Unfortunately, I ran some technical errors and the video failed, so I'm unable to post it. I was going to post an extract of the front end and back end video. It's a very good one, but in a nutshell, essentially, the front end of an app is what the users interact to see publicly, as you can see, like the web app or the mobile app. And the back end is typically what the users don't see. It's what the web developers work on. I mean, they work on both the front end and the back end. They both require different programs. Besides just using HTML for everything, there's a structure which controls the server, the database, and the file server. And it's kind of weird I'm teaching about web development here, but bear with me, guys. It's kind of relevant. And here comes what I was going to teach about, the decentralized finance. Very interesting topic. I think it's sort of the meat of my class overall. And as you can see, compared to decentralized finance, compared to fintech and traditional finance, they accomplish the same thing. However, they do it without transit intermediary, like I explained over, like the banks, and also through fintech too. And I like to copy this quote from a man named Alexandro Mario Lagagna Tocci. That's a very long name. I'm not sure if I pronounced it correctly. He's the creator of the article that I'm mostly citing here. I'll put the article in the citation tab so you guys can read it later on. DeFi applications allow you to transact without trusting banks or institutions 24/7 in a cheaper way, or without any possible be censored by governments, some financial cartel, and even independently from malicious regulators. In some countries, regulations can censor market entrepreneurship and free market. And yeah, that's the whole point of decentralized finance compared to traditional tech we use, which is the state. You rely on the cash, or you rely on apps like Revolut or TransferWise, Cash App, Venmo. While decentralized finance relies on token transactions and cryptocurrencies like Bitcoin and Ethereum. Mostly Ethereum. Remember, the only way you can make use of the fancy stuff in the blockchain is through Ethereum right now. And through lending, you can. This surprised me. You can actually borrow and lend money even with through decentralized finance. Normally, you have to go through the bank. In recent years, you've heard about the Lending Club, which is basically peer-to-peer lending, but with on a traditional fintech that we're used to. And through decentralized finance, hypothetically, I haven't seen a good example of this so far, is you have to do it through tokenized peer-to-peer debit. You're able to lend and give and take money through strangers, and that would have been unthinkable compared to a traditional finance. Because as you well know, banks, they're very selective in when they give the money to. I believe there's a quote saying by, if you owe the bank $100, that's their problem. But if you owe the bank $1 million or more, that's the bank's problem. They have to choose their clients very well. They can't just choose anyone to lend money to, or else they'll get into bad financial situations. And with banks, ooh, you never want to go down too badly. In exchanging assets, investment banks can allow you to use exchanges that allow you to trade American and international stocks. Fintech so far, there's not much on it. You could argue that apps like Webull or Robinhood allow such things like that through no brokerage fees and easier time to invest to buy stocks and sell them too. And through DeFi, you use decentralized exchanges. The examples of this I'll show is Uniswap and Fork Delta. I'm not familiar with Fork Delta, but I'm kind of familiar with Uniswap. Unfortunately, if you guys heard a term about rug pullers, essentially the textbook scammers that you always hear about in the crypto circles is oh, got chat. Pancake swap, yes, that too. And a lot of the famous rug pullers, as I like to call them, they try to use the Uniswap because it is so decentralized, and a lot of people get scammed through that. I've personally been scammed. I've known from personal experience. There's oh yeah, Squid Games. That's a good one too. That's a recent rug pull. But I believe around last year, I invested in a token that allows you to get access to chat rooms and some weird things like that. And unfortunately, the creator just suddenly rug pulled on us, and the whole value of the token just dropped. Yeah, I kind of lost money on that. I mean, I had insurance in case he did that, but it's still, he did very suddenly. It still kind of surprised us. You're careful of Uniswap. It's a very good decentralized exchange, but a lot of the rug pullers like to use that. Let's move back to the previous tab. And investing money. Yeah, Robinhood, as I said before, you can't exactly exchange assets on Robinhood or stuff like that, but you can easily buy money, buy assets, but financial instruments like a stockbroker, and they recently go into crypto trading too. If you guys remember GameStop, they kind of Robinhood kind of did a scummy move there by kind of restricting trades on GameStop for everyone. They're technically not allowed to do that at all. And have I heard? I've heard there's actually going to be a class action lawsuit against Robinhood regarding that. But however, I haven't heard any recent updates on that. That's the thing. FinTech is not really on your side, despite all the innovations and cool stuff they say, like peer-to-peer, user-friendly. They're not really on our side, unfortunately, particularly in the whole GameStop financial. And decentralized finance is hopefully trying to be a solution to that, which they offer tokenized financial products like ICO, STOs, and token baskets. And I went briefly here to talk about Uniswap, but I'll talk a bit more about it. Here's kind of the current apps as of 2019. This article I'm quoting it from is from last year. So there might be new apps. There's a lot more new stuff here. You have Ethereum being the backup, the application layer, and you have the user aggregate layer. Essentially, you have all the cool stuff you're able to get into, which decentralized exchanges like Uniswap, Fork Delta, decentralized stablecoins like DAI. A lot of people like that, but I'm not personally into it. Be skeptical of what the people of stablecoins. That's my opinion. As I said in disclaimer before, it's my opinion, but from my experience, stable coins aren't exactly as stable as they like to teach and show themselves as. It's all marketing. And decentralized loans like Compound, and not really on a list, but it is an example the author does put out. It's still a new concept. I'll be careful of these products, guys. This stuff is pretty new. It's so they're a lot of vulnerable to a lot of security vulnerabilities and a lot of bad policies too. Hopefully they'll get a lot better over time. That way more people can use it. Okay. Sorry for that. The potential blockchains. I believe this is a quote on the article that I quoted. The guy is quoting another guy while I'm quoting the creator of the article, kind of a triple layer thing like that. Private blockchains were not a good start from Matthew spoke on Forbes, but they are not the future. Interesting opinion. By definition, private blockchains are not truly open. They can provide control and leverage to a select number of individuals. A truly open blockchain network, a public one, will always be a semi-decentralized one. Why? The more decentralized, the better, because less control over users is better, and because the network of various counterparties can grow faster as industry participant changes. Finally, privacy and security. In an era in when rarely a week goes by without news of a major data breach, the single best way to safeguard process integrity is on a public blockchain. Once a fully decentralized blockchain can protect against a single point of failure, only a fully centralized blockchain can protect against a single point of failure. Private blockchains are only as good as their weakest link. I agree to an extent, yes. Blockchain is still an early technology, everyone. It's not entirely perfect. And this is from Forbes in his article, Private Blockchains Were a Good Start. But the article I'm quoting on this does have the link directly to the article. So if you guys want to check it out, I'll send the PowerPoint to you guys, and you guys check out the citation list. And here's citation list. How censorship-resistant digital goods, DAOs, and DFIs are driving a new digitalization era. I believe that's what the core of what I'm trying to teach with this class. Essentially, there's likely going to be a new era of new financial tools that we have access to. And that's going to bypass the traditional finance industry and through fintech too. And here's the front end and back end explanation. Unfortunately, I wasn't able to send the video this time, but I will try to add the video extract on the PowerPoint that I'm going to send to you guys. Remember, I always send the PowerPoint that I teach to you guys. That's it for it now. And there's a couple things I want to show you guys. I'll switch to my smartphone for this. That way it's a little easier to share the links. All right, I'm switching to my smartphone right now. Okay, it's a bit slow at the moment. The Zoom is still itself still having all these kinks after at least a year. Okay, it's being unusually slow. Actually, I might also just search it up right now on Google. I'm sorry, everyone. My technology is very slow. Okay, thank God now. Okay, for now, I'll just show it here right now. Sorry for that. Okay, take a look at this one. This is insane. It's a McDonald's McRib NFT. You got that right. It's a 10-second piece of media of a floating card of a McDonald's McRib floating. They hired an artist for this. It's crazy. McDonald's is getting into the NFT game and they're giving it out. I'll post a link in the chat if you guys want to check it out a bit more. Yeah, I heard about that too. Unbelievable. I didn't expect the big corporations to jump on this trend, the NFT train so far. What I do want to show you guys is the Twitter replies too. It's very interesting. Okay, wow. I forgot that Twitter doesn't allow you to view the comments, unfortunately, unless you signed in. Very bizarre. Show more replies. Look at the quote tweets. I think that'll be easier. Yeah, essentially it's kind of it's an interesting thing that McDonald's did. However, there's basically seemed to be a negative reaction to this. For my opinion, it's I wasn't able to show the comments below the tweet, unfortunately, but McRib has a full cult following. It does, and I think McDonald's is taking advantage of that by selling an NFT, by giving away NFTs on it. Again, I'll try to look at the comments again. Kind of Twitter's being odd. Yeah, basically stuff like this. People are saying, "Got it for free without retweeting." As I mentioned before, NFT isn't just the image itself; it's the proof of ownership of the media. People like to say, do an easy gotcha, saying I can easily just right-click the image and just take the NFT for myself. Sure, you can take the media or the file, the picture, but that's not the NFT. That's not how it works. People still can't understand that. Yeah, they're basically just downloading the video from a tweet and just reposting it, saying it's mine for free as some sort of gotcha. That misses the point of all that. Yeah, as typical NFT tweets, they attract a lot of NFT creator accounts too. Yeah. NFTs aren't very liked very much on Twitter, unfortunately. What's your guys' opinion on that? I have always talked about NFTs as a potential as a outlet for art and other useful useful stuff, but it seems like nobody really likes it. They view it as a fad. I think that's kind of unfortunate. Oh yeah, it's a classic one. Essentially, NFTs aren't exactly well liked among the public. Flipping JPEGs. Yeah. Others not so much. I agree. I mean, NFT is it does go beyond just using it as art, but it does have multiple uses for it too. You can use it as a kind of an event pass, exclusive token, kind of a badge, that kind of thing. But I don't know, from the view of the public, it's like because there's so much articles about how an NFT got sold for like $1 million and all that stuff. People just view it as something as just a rich people thing, as something a toy for the rich. Unfortunately. Anyways, you guys have any questions so far? Actually, if it seems like Professor Sweet and Jay, you're the only two here, so I'll just put your attendance on the sheet. You guys, I won't post it. Yeah. Seems like we got less people than normal, unfortunately. I think last class kind of scared them off when I posted on the official Telegram and I posted on somewhere else too. Seems like people are kind of busy today. Anyways, do you pay taxes on profits when you sell an NFT? Yeah, you do. So I haven't. I wish I did a bit more on the tax information, but essentially, the government has the mainstream financial tech and the mainstream financial industry has adapted somewhat quickly to the crypto. It originally overwhelmed them, but to a certain extent, they have adapted and a bunch of new regulations passed. Yeah, now you have to pay taxes on the profits you make when you sell a token, and that does include NFTs too. The NFT. The thing is, the transaction is online on a blockchain, so you can easily send tax information on that. As to whether you have to open a business in the eyes of a government in order to send a tax that way, I'm not sure if that's possible. Again, I'm not a tax advisor. I'm just a college student. Seems like it's going to be a quick class today, unfortunately. I wish there was more people who showed up, but it seems like everyone's kind of preparing for the meeting later on. Yeah, we have anyways, everyone, thank you for attending my class. And I wish I kind of explained a bit more and more thoroughly, but unfortunately, technological problems kind of ruined me at the end. Anyways, Ronald Sweet, thanks for being here, and thanks Jay Hernandez too. And as for attendance, as mentioned earlier, I already took your guys' attendance so far, just for you guys. I don't have, that way you guys don't have to click the link and do all that stuff. Anyways, thanks guys for showing up. I'll see you guys next Wednesday. For our next topic and next Wednesday, I'll cover a bit more about NFTs and other products in decentralized finance sphere. Anyways, thanks for showing up. Bye, guys.
All right, everybody. I threw the new tech model in the folder. If you guys don't have access to that, let me know. I can get it to you really quick. If not, feel free to look on with someone else. I'm not sure if all the Bloombergs are up. Bond, do you know if all the Bloombergs are up? Still no? Oh, okay. Yeah, so Bloombergs are still scarce. If you don't have your own, just look on with someone. I don't know if this class is going to be the same size next semester. I hope it is, but if not, then there will definitely be Bloombergs available. Let me just take attendance really quick and then we'll be on our way. It's tech model. It should be. Let me get rid of that one, sorry. Take attendance. Use your Kaylin, not today. Alex Montmayor?
Yeah.
Okay. Angel, not today.
Here.
He's on Zoom. Drew, not here. Mitchell. Awesome. Bond's here. Anna's on Zoom. Will's here. Brian on Zoom. No. Right. Eduardo's here. Brennan's here. Jay and Hearn is here. Lewis. Lewis. All right. All right. So we're going to try to get a better correlation today, hopefully increase our R square. Remember that R square is the measure of how much, or the variance, how much of the variance can be explained by the metrics that we're using. So sorry, it's loading. Right. Can everybody see this on Zoom and in person? Yes. Chat. Yes. All right, great. Of course, if you're not here in person, I think each of these has a pace value section. If you would like to download and do it from home, you won't be able to add any new metrics, but you will be able to mess with the ones that we have. Maybe you can find a combination of these weights here that'll get us a higher R square. End of the day, that's the purpose here. Does everybody have the same workbook? Yeah, all right, great. Okay, so let's take a look. So it likes sales 3-year average growth. It doesn't like trailing 12-month profit margin. Interesting. Doesn't like return on assets, return on investments. It likes gross margin. And it likes the change in EVA, which is the one that we calculated last time. As you can see, it does look a little different. I put all of the historical metrics over here. So this is history. We're going to try something with, there's a similar metric to return on assets. It essentially measures the same thing. It's a earning power ratio. It's operating profit to total assets. So let's try that. Operating profit to total assets. So let's just go all the way to the right here. Open our Bloomberg find fields. Then we're going to do see if it has it on its own. Operating profit, operating return on assets. I don't know if that's it. Do you think that would be? Does anybody think that would be operating profit to return on assets? Maybe. It'd be better if it gave us a definition so we can look. It sounds like that's what we're kind of looking for, right? Let's see what it populates here. Let's add that to our model. Yeah, okay. Let's operating profit. Don't want ARD. Employee, industrial, well, we could use NOPAT. Let's use NOPAT. Let's try it. Yeah, old tax. So is their earning power, how strong their earning power is related to their assets? So I guess it would be a measure of efficiency. And we just need total assets. I don't know. Total assets. Let's try. Okay. I'll just call this. All right. So this is the one. This is the one that we're going to calculate, and this is Bloomberg's here. This is just a test to see if it's going to work. If it does, we'll go ahead and insert it into our model, but this is just like, we're just going to look first. And we don't want these formulas. We want these. Not this one. We want these. So just any one from here. BDP ticker to metric. And then we have that if error. I'm just going to copy across these three here, paste. And this is our metric. So we're going to do NOPAT to assets.
just copy all the way down. Let's see. These are different metrics. Probably because we're using NOPAT to assets. And it's Professor, would you know what operating profit return on assets is?
But it's just return on assets using operating income.
Okay.
So if you did BTO times margin, it should be almost exactly the same. I'm a big fan of operating. It's usually the same as the dollar.
Let's see. They're fairly similar. Operating ROA and ATO margin. Some cases. Let's see. So what do you all think that we should add to our model? Should we use asset turnover times margin?
You've got most of the big ratios in there, right? You've got turnover margin, internal capital, UTSA, right? The ratios you might try, just out of curiosity, is the A&R function. You might have the A&R. What we've used on that before is how many buys versus sell recommendations. Maybe looking for firms that have more buys and sell recommendations. Something like that. You can bring those in. The expected earnings growth is another one.
So I would just insert that into the find fields.
We have to find the Bloomberg one. You have to bring in both the buy, you do over on the right, buys in the sell, and look for some kind of ratio or something. You gotta be careful with the ratio because if you have zero, you have to buy.
By zero.
You could take the buys divided by the buys plus the sells, or you could take the buys divided by the buys plus the holds. You could say if the denominator is zero, give me zero or something like that.
See, could you walk us through that?
Yeah, you have to find that. You step in the out. Go out to the right.
Yeah, somewhere else. Where are you putting the stuff off to the right? Don't you have some stuff off to the right? Yeah, so go way off to the right there. All right, we'll just have to find it. So go back to the Bloomberg and see what it's called. That might help us find it. Consensus rating. So we can try the word consensus and see if that helps. Yeah, this Bloomberg's really slow today.
So Bloomberg web view stopped working.
There's a total analysis
recommendations too.
So analyst ratings, so yeah, that might be something.
We do have those recommendations.
There it is down there, recommending consensus. I don't know what that is. You can bring it in and see what it is. You have to look and see what it means. All right, so I don't know what, if 1 is good or 5 is good, so you have to find that. Might be back on that Bloomberg page. Does it show you a 1 and a 5? And what you can do, get another Bloomberg screen. This is pretty cool, or bring in another Bloomberg screen and type your company, some company.
It's Apple.
Okay, and F8, and then FLDS. And then just search on consensus. Okay, just click on it and see what it tells you. The analyst opinion security rating is calculated by converting each of the analysts. Each number 1 to 5. So is 1 good and 5 is bad? Or is 1 bad? And so you got to figure that out, right, before you set it up.
It's 1 is bad, 5 is best.
5's like 5-star.
Yeah.
All right. So higher is better. All right. So that tells you what you need to know. The other thing you might bring in the number of analysts, and I think they give you that number as well.
Yeah, it's called total underscore analyst recommendations.
Because you only have 1 rating, that might make you kind of not get much ratings to it.
Yeah.
Oh, they got a 5. Wow.
Yeah, there's one right here. There's one analyst and they give it a 5.
All right. And then so what could we build out of these 2 fields, Professor?
Well, essentially, what you're saying is these people spend a lot more time than you have. So what you want to do is just see, first you just run the correlation, run the ranking, just see if it tells you anything. If that's all you're going to use, that ranking, then you could add it on the left and just add it in as a new ranking. And just rank it like everything else, column 0, and higher is better. I know the downside is, if that's the case, then why run the model, just go buy all the companies that have 5 ratings. But their ratings should include both what they think of the company and the stock valuation. So they're not just saying it's a great company, they're saying it's a great company for the price. It's the exact same thing they're doing. That's my mind, that is on correlation, because if you're taking price into consideration, then it's just, tech is different, so.
One. Do we have to re-rank this one as well? No, right?
What's that last one?
This is the ranking.
Oh, yeah, so you just put it into your overall market. I don't know what that is. It's the rank. Oh, COM 0. Yeah, COM 0. Higher is better. I just need to move that over to your model. Go over to your. I would add it. I set it on the right, but you haven't really adjusted it. So maybe just throw it in there somewhere. Where you keep going left. So keep going. Maybe put it between, well, you don't want it there because it won't be in your, maybe between the green and the purple, or the pink, green and the pink.
Yeah, that's right. Yeah, it's like, I mean, this.
So yeah, you can just copy it over.
Yeah.
What is it?
Too much. Too much in the workbook.
Should be able to do.
Oh, it's recapturing everything. You made one little change, it's like, we gotta redo everything. All right, so bring that function over. Probably could just copy it over or just cut it over. Well, no,
It would be just the ranking, the ratings, the analyst recommendation,
well,
or the rank. So,
I just do
yeah, just try that one first. I'll just copy that one over and just see. We may find it doesn't help you.
particular. US equity.
Add a column on the end there.
Yeah.
Just copy it over.
And you can see, you see where it says measure, right? You know, so.
Right, and this one probably can just copy, copy the one next to it over, not that one, but come over to, come back over to where you were in the rankings. Okay, I think you just copy that AE5 all the way down over, can't you? So, oh, you've got too much link locked, so you want to lock the 6 through 311, but not the X. Now you can copy it over. And then copy your title over too. So AE5, copy that over. Now you can just copy the AE5 over. Yeah, just copy that. Oh, wait, what happened? Could you put it in the right spot?
I referenced this cell here instead of referencing.
All right, so make sure you go find what column it's in because maybe you're in the wrong. Keep going left. So it's J and K. Yeah, I don't know, man. Where did it go? Where's the J? Go over to the left. Let's see. I mean, come back over to your rankings and find the one referencing J. This one here. Yeah, you should have put it to the right of that one.
I see.
Okay. Yeah, you're just off a little bit. So input on X. I don't know, maybe you don't have them all in the same order. Yeah, click on X and put it over there. X. Insert there. And then copy that. No, not that. Go back up. So you want to just copy the ranking ones over the one you did. Actually, you should just be able to copy W5 all the way down over the X. Just copy that whole thing over the X. If you didn't lock in the row, go down to your in the 6. Oh no! Wow, where are we? I'm really confused. Okay, that's not. Take that X out. I was wrong about that. Okay, go over here. We said it was next to net income, so maybe it's ADs or AEs where you need it. Yeah, maybe you just missed it by one column, so it's AE instead of AD. So add a column in AE. And then copy AD5 over. Yeah, there you go. And then go down to AE6. Yeah, you've got a problem with it. You got the W locked in, so you want to redo all of those formulas, or it's going to kill you one of these times. There, now you can copy that down. So now it's good, and you can just delete that KG. Yeah, that should work. And then just put a 0 up there in AE4. And rerun your solver. It should all be set up to go. It may not do anything after all of that, but it's good practice to put those in.
I hope it does.
Well, it's doing something. It's 29. Did it allocate anything to it? Yeah, it allocated just barely. But that's, so the other one is expected earnings growth. So I would do the same thing with that one, just add a column like right next to what you just did. And then use the front part. So just go to Bloomberg and just type in the word expected and see what comes up. Oh, you're too fast for Bloomberg. They may have expected revenue and expected earnings. Do expected space growth. Let's see what happens.
Long-term growth, earnings.
Type the word space 5.
Long-term growth, EPS.
Long-term backspace. To EPS. Estimate, I think that's estimated long-term EPS aggregate. Projected EPS growth plus yield. No. Just try the word growth. That's really good.
Revenue growth year-over-year.
That's
EPS 1 year growth. Best long-term, best estimate.
I don't know that BDFB, projected 3-year that's typical growth, next year growth.
Growth.
Type the word peg and see if anything comes up.
Best peg, best next year, current year, next 4 quarters.
Did you try a peg ratio in yours?
Yes, sir.
Yeah, you're probably getting a lot of NAs when you do that.
Yeah. Or we did the historical peg and calculated that.
Oh, yeah, so
There was a lot of those.
I know it's in there, so go to the field search, because if you can't find it in there, go into Bloomberg and just type FLDS. And then just type the word expected. And it's a lot easier to look for it here. And you can move that out of the way. So we're looking for something that looks like a growth. Okay, so we want the word growth. So come down the page. And those don't look like it. This is Apple, right? Yeah. Coming down. That's the EPS.
3.
I mean, you could always bring that in and the current one and do your own calculation. But that, I know they have it, so keep looking. We've used it before. I tell you what I'll do. I mean, keep working on your model. I'm going to look up the old tech model and see if I can find it on there.
Yes, sir.
Yeah.
All right, everyone. Our model needs a little more work. Let's keep working on it.
I'll find that account and give it to you. That one has been really powerful in the past. It's not one I like because adjustments are they?
Yes, sir.
And we'll give you some names. I'll have to find it. I just can't remember the account. I can find it real quick. I'll get it to you right now.
Yes, sir. Thank you, Professor. Let's try
Let's try operating return on assets. There, here.
Oh, it's,
Okay.
it has rate bills.
Yes, sir.
Best estimate are long-term growth. I think we saw that one. We'll get a lot of names. Best space, ES2 space, EAR space, long space terms. Best estimate long-term growth.
EAR.
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 You can't find it, you can actually just type it in there. They want, just type it in there. So that's all. Type best EST. EST. PM long.
PR.
PAR. Long underscore growth. See what comes over the top of the. Oh, wow, that's not bad.
Few. Kind of a lot.
Oh, you're getting the zeros because of that. Okay.
Yes, sir. Kind of a lot.
Yeah. I don't know if I would use zero, you might use minus 20 or something. Zero might be pretty good for something like this. You can try it, see if the model likes it, if it doesn't like it, it doesn't ignore it. I'm looking at their model. It allocated 29% of the model.
Wow.
Everything else, oh, the other thing they had, that you might put in there, their model allocated 4% of the short interest ratio.
Short interest ratio.
Yeah, and on that you use common one, so that's the other one they have. They have one other one, write these down. So short underscore INT underscore ratio. You can just type them up there. We have one other one that we have. Oh, there's another one. Two more for you. I should just send you this model, right?
What are they?
Next one is CapEx underscore sequential underscore growth. That one uses comma 0, short interest uses comma 1, and the last one they use RSI 30 days. And that one they use comma 1. Everything else you have. So
RSI underscore 30 day. 30 D. Okay. RSI underscore 30 day.
So those ones that they have, you don't have to allocated. And the long-term growth is 30% of the model, so.
Wow.
It's probably gonna work. They have EBITDA margin, you already got that one, right? They have the 5 with the fall, you already got that one. There are square.
We don't have EBITDA margin.
The correlation was 70. But I don't think they did the eliminate outliers.
See,
So what is your correlation running?
76.
So you're already better than that. So if you add those, you could probably get better. This model has Yeah, so try those too.
Yes, sir. Thank you, Professor. Let's see.
I keep all y'all rolls.
Okay. Just give it a moment to load. I think we get all MAs for CapEx sequential growth.
Doesn't exist.
Stuff sequential. Yeah, it just doesn't sequential. Try finding it in the fields window search. Just try CapEx and see what comes up. There you go. Ah,
Shouldn't type it, professional.
Let's see. All right. So we said this one is on the 0. The comma 0. We want comma 1. And then comma 1 in this one as well.
Yeah, yeah, whatever, yeah.
So data solver. All right. It's working. Working hard. Let's see. 76.
Didn't change.
Well, it did to the short interest ratio, or short ratio. It did to the operating ratio, or operating return on assets.
Well, I think you may be getting there, pick out the outliers one more time. The other thing we did, and this is time consuming, but, Dante's doing it, is to take the sub-industries and just calculate the correlation of the ranks by sub-industry. And just maybe do a table, and then if you see one that, like, maybe it's 0.8, 0.25, 0.7, and we have one that's negative 0.2. Have you tried taking out industries, sub-industries?
Taking out sub-industries.
It's real simple. You don't have to actually delete them. You just find them and you sort it by sub-industry, and then just highlight the two that you're doing the correlation on, those two, and just delete those cells. You don't delete the companies. Look at your R squared, you run with your solver. You try to find with one particular industry like semiconductors, it's just messing you up. So that's another approach. So beyond that, we're getting close to the final what we can do. The models that they have, they did really well on this team actually did pretty well. Their correlation is slower than yours. They still got all right. They have a pretty decent looking chart too.
Let's see. So they ran.
Not bringing the sub industry.
Yes, sir. I have them here.
Yeah, so you just sort them by sub industry, and then we put in make sure you go all the way over to the right. Sort by sub industry, and we just put in the view, like these skills, and just go down each sub-industry and just relate their two ranks and just see what it does to those. That may take you a little too much to say that for next week.
Okay, yes, sir. All right. Well, it's 5:30. This is what we have so far. We have a correlation of 76.8. It liked the operating return on assets, 21% allocation. It took some from the cash ratio, which is good. Bloomberg default, it's still not allocating. Our 30-day RSI not allocating. Sequential capex, net income growth, return on assets not allocating. And it's still giving the most weight to sales 3-year average growth. So I'm gonna keep working on this in the background. Next week will probably be, would you guys be willing to do it for 2 more weeks? Next week, get it down to the T, and then the week after, look at the companies that we want to evaluate. So in 2 weeks, we should have a somewhat complete model. Next semester, we're going to recreate it all over again with the metrics that work the best, try to get the highest correlation. If there is a metric that comes up over the break, let's go ahead and discuss that. But we're headed in a good direction. We're headed in the right direction.
That's actually stronger than that. You're in the neighborhood of 5. Yeah, I think it does affect part of it. Because everybody can text focus on the future and using a lot of mixed focus.
Yes, sir.
All right, good enough.
All right, everybody. Thanks so much. Have a great rest of your week, and hope to see you next Thursday.
You can just log out.
Yes, sir. All right, everybody. Thanks for joining on Zoom. If you haven't left already, they did.
So today we're going to cover, we're really just going to focus on functions. So brief overview. So what is a function? A function is a device that groups together statements that can be used more than once. Why we want to use it? Because it allows us to repeat code that instead of having to use it over and over again. So save time, save space, like file size. So we've already seen this before. So for instance, instead of writing a for loop every time we want to count the items in a list, string, or dictionary, we just call upon the length function. So how do we create function? We start with the keyword def, which means define, followed by the function name, and then parentheses, and any parameters if there are any. There doesn't have to be, and then colon, and then you indent it. So it looks a lot like the for loops and the while loops, the same kind of syntax. Want to be careful not to name it the same name as a built-in function, so such as length, sum, range, and print, because that'll mess up your program. So if we want to call on a function, for instance, one that doesn't have any parameters, we'd simply just type in the name followed by the parentheses. And then, so we see over here, I have a function that prints hello world. And then just called upon it right here, the parentheses. But if you forget the parentheses, what Python's going to do is it's just going to tell you what it is, which is it's a function. It's also going to tell you where it is. It's located in main, and we'll get into that, what main means in another lecture. So I want to hop on to the Jupyter notebook. We're going to create a function that converts Fahrenheit to Celsius. So we'll start with the keyword def. I'll name it F underscore C, parentheses, and then I want I want a parameter because we need a number that we're going to convert, colon, and then here we wrote down the conversions. I forgot myself. So it's going to be print x minus 2 times times 9 divided by 5. So if we call on it f underscore c, put in parameter 57, and then run that, it'll convert it to Celsius. Any questions on that? No? It's pretty straightforward. So default parameters. So we've already seen default parameters like in indexing. So when we input, if we left out start, stop, and step, it would start at 0, like the first index, stop at the very last one, and it would count by 1. So we can do the same thing with the functions we create. So right here I have functions say hello with a parameter name. And if I left out the name parameter like I did right below here, it's going to give me an error saying that one parameter is missing. So if we want to avoid that, do is with the parameter, these are also called temporary variables, just set it equal to a value. And if no parameter is passed, it's just going to automatically, it's just going to default to that value. So far we've really only seen print. But there's another important function called return. So the key difference with print versus return is print is displaying to the user, while return is going to actually save the output. So over here, we have a function just adds the sum of 2 numbers, and then it'll print it out right here. Or that's part of the function, is it prints it out. And then if we want to assign results is equal to the function add sum with the parameters 3 plus 3, and then we print results, it's going to equal, it's going to display none because it didn't actually save the value here. So to fix this, we put return in its place. So like as I said before, the return function, it saves the value, but if you notice, it doesn't actually output anything right after we define it. And then just to go back to the none. So what a none type is a value, is a variable that doesn't contain any data. And we've seen before with the type function, we can see different types of integers, floats, strings, lists, and then we also have the none type here. So this is the same function that we were just using, except with it has the print function here. It's the same mistake as earlier. So let's do another exercise. So the first one is we're gonna do together, and then I have a couple for you to do individually. So the first one, we're gonna create a function that prints all the even numbers in the list. So let's start with the keyword DEF. Name it even. And we want the parameter to be X or whatever else, doesn't matter. So I'm going to use a for loop here. So for none, actually, hold on, one thing before we start going to that. There are also temporary variables. that we can put in place for the function. So we're gonna have a counter. New list actually. We're gonna leave that blank. So this variable right here, it's very similar to this temporary variable name right here. It holds it within that function, and then as soon as we're done with that function, it deletes it. So for num in x, if num, and remember the mod function, mod2 is equal to 0. New list, append. So it's saying, so if the number divided by 2 has a remainder of 0, append it to this temporary list right here. Else pass, what we saw earlier. So let's test it out. Should forgot one thing. All right, we'll do it later. Now let's print even. Actually, we should do it. We want to add in a print statement so that we can actually see it. Print new. Yeah, we want to print the new list so that we can actually see it. There we go. Okay. Any questions on the temporary variable over here, or anything else about this? Make sense? Cool. Okay. So for the individual ones, create a function that converts pounds to kilograms. Create a function that prints the numbers, the number of words in a string. So this is similar to the exercise of that we had last class. And then lastly, create a function that erases duplicates in a list, then return that result to a variable named new list. So give you guys 10 minutes to get that done, and then we'll go through it together. Okay, so for the first one, kilo, and for the parameter, I put default parameter of 0, and then the conditional statement, if x is equal to 0, then print, please enter a number, because if it has no parameter, no parameters entered, please print, have it print, please enter a number. And then else, just print x times 0.4, the conversion rate. So for the second one, I have a temporary variable here, counter, set it equal to 0, and then I used a for loop. So for num in x dot split, because x dot split, remember it defaults to separating everything out by white space. So for num in x dot split, the counter plus equals 1, which just means add 1 to the counter, and then lastly print the counter. And for the duplicates, this one was kind of tricky because we're using a set, or we're using a function inside of a function. So we're using the set function. So for the duplicates, so for the parameter is equal to x, and then we just reassign x is equal to set, and then x. So this converts it to a set. And then second step is just return list x. So all we're doing here is we're converting x to a set and then back to a list, because sets automatically remove duplicates. Do you you guys want me to keep that up on screen for a sec? The space, you're talking about the space from right here to here? No, that, I can have it bunched up. So I just do that to make it more readable. The space from here to here, these tabs, those actually matter. And next time I'll cover, I'll try, it's kind of complicated, but I'll try to explain what the tabs mean. Other than that, that's all I have for you guys today. Is there anything you guys want me to cover next time that I skipped over, or maybe you saw online, you wanted more detail about it?
Right away. Something.
Well,
More problems when you're done.
I mean,
That's up to y'all. You don't get the semester.